Here I have given a table that gives us a quick comparison of capital markets and money markets. Financial institutions and banks, corporate entities, foreign investors, and ordinary retail investors from the public are the main participants in capital markets. Institutional participants, such as the RBI and banks, financial institutions, and finance companies, are the normal participants in the money markets. Individual investors typically do not participate in the money markets because the amounts involved here are usually quite large. Equity shares, debentures, bonds, and preference shares are the instruments which are traded in the capital markets. And short-term debt instruments like treasury bills, trade bills, repurchase agreements or repos, commercial paper, and certificates of deposit are traded in the money market. Capital markets are typically accessible to individuals with small savings because they can buy one share or two shares or any small number, which means that large sums of money are usually not required, unless of course you are buying some very expensive shares. But in money markets, the transactions entail huge sums of money and the instruments are quite expensive, like crores of rupees. So normal individual investors are usually not present in this market. Capital market instruments like equity shares have no specific duration, and others like debentures have a maturity or an investment duration stretching across many years. Whereas the instruments in the money market have shorter tenures, maximum of up to 1 year, and sometimes the tenure or the maturity can be as short as a single day. The instruments in the capital markets have a reasonable level of liquidity. They are normally marketable on the stock exchanges. However, in some situations, especially if the share is not being actively traded, then finding a buyer can become difficult. But money market instruments are highly liquid, especially because they usually have some formal clause or an arrangement that guarantees liquidity. And also there is an organization called the Discount and Finance House of India, that is DFHI, which was set up by the Reserve Bank of India, which provides a ready market for money market instruments. In terms of safety, capital market investments are considered riskier in terms of both the returns and the principal repayment, because the issuing companies may fail to perform as projected, so the value of the shares or the price of the shares goes down. Or there is also a possibility of the promoters defrauding the investors. But money market instruments are much safer because, first of all, the shorter investment duration reduces the risk, and the issuers are usually financially sound entities like the government, banks, and highly rated companies, which minimizes the risk of default. Capital market investments may have higher returns because of the capital gains on the equity shares, the dividends, and the bonus shares. The investors here are taking a higher risk, so the returns may also be higher. In the money market, the returns are lower and usually guaranteed, such as a specific percentage of interest. The focus here in the money markets is on safety and liquidity. So money markets are suitable for short-term investments of surplus funds.